And now to calculate the revenue forecast. So when we calculate revenue forecasts, we want to do exactly the opposite of what we did when we were building the model structure. When we were building the model structure, what we did is we split up the drivers eventually into price times quantity. And that is the reason why we made estimates on price and quantity. The final items that we have split into. So when we're doing also the calculations, what we want to do is we want to calculate the numbers for the price and quantity first, and then build upwards towards the geographic revenue, the product revenues, and the total revenues. So we're going to start from US Botox vials sold in row 18. The formula should be the former year times 1 plus the growth rate. So we're multiplying 1.127 to the previous year. We're going to copy it across, Control R. And the formula structure is very similar. Actually, it's exactly the same. So all we have to do is we have to do Control C, Control V on each of the price and quantity lines. And you can always double check by pressing F2 and making sure that it's all linked properly. And it seems it is. And one last item that we have to calculate is for the cosmetics. So the cosmetics as well, the formulas are in the same order. So all we have to do is copy one of the formulas and just paste. And again, F2 just to double check. So we have the numbers for the price and quantity. And if you want to convert it to revenue, all we have to do is we have to multiply these two. But the issue here is the units. We've upgraded the units to 1,000 decimal points, so 3 decimal points. So this time we're going to downgrade the decimal points by 1,000. So we have to divide by 1,000. That's 10 powered by 3 and to the right. Again, the formula structure will be exactly the same 3 more times. So we're going to copy, paste for Botox International, paste for filler US, paste for filler international, and we have the geographic revenue all ready. Now there's an error sign, there's a check error sign for the international revenues. It's because of the inconsistency in the formula. So you can see that we have a gross formula for the cells up and for the cells above, but this row is the only row that has a different formula. So the Excel is trying to give you an indication of whether you made a mistake or not. And in this case, we did it on purpose. It's not our mistake. But sometimes these kind of error messages, they do help us. So if you encounter this message out of the blue, always click on this and try to see what went wrong. And sometimes you did make mistakes. So it is helpful. But in this case, let's get rid of all the error messages. You can just select the entire area if it has errors. Shift Alt and the function 10 key. So Shift Alt the F10 key. If you press once, you'll get this pop-up depending on your Excel version. But if you press it twice more, you'll get to this pop-up, and all you have to do is to press I for ignore error. And lastly, Botox revenue would equal US revenue plus international revenue. For fillers, US revenue plus international revenue. Whoops. And lastly, for the total revenue, it's going to be the sum of the three products, so Botox, fillers, and cosmetics. And now we finally have our total revenue. Final formatting for cosmetics. I'm going to highlight the rows. So we have our numbers ready, but that's not the end. We always want to look at, double check our formulas, and we want to look at our results and see how it turned out. Is it too aggressive? Is it too conservative? Is it what you intended? Is it lower than what you intended? So checking our results. So in order to check our forecast results, we also need the compound annual growth rates to be efficient in the analysis. So what we're going to do, we're going to build a CAGR once again using the rate function. How many years? 1, 2, 3, 4, 5. It's again a 5-year CAGR. So 5, comma. The second one was always 0 for no, well, I didn't explain the reason for it. Just put in zeros. Minus the starting point, comma, the ending point without a minus. Let's shift it to the bottom first by using Control down. And then what we're going to do, we're going to copy this format and paste it onto the column right next to it. So Control C to copy. One column to the right, Alt EST. Enter. And now we have the compound annual growth rate for the forecast as well. Let's see how it turned out. So total revenue would grow 10% for the next 5 years, which is, well, it's slowing down compared to the past 5 years. But as I mentioned, the slowing down trend has been reversed to its historical average rates. So in some sense, some people might say that it's a little bit aggressive. We have 3 types of product revenues. So we're saying that all 3 product revenues are going to decline in terms of growth rates, and also decline for all geography segments as well. Especially for US fillers, I think we're being too conservative because basically we're assuming no growth at all. So no growth at all. We do have some growth from quantity, but it's going to be offset by a minus growth in average selling prices. So as a result, no growth in the US filler sales. But for the others as well, we are going to see quantity growth, but it's going to be partially offset by a decline in price ranges, price levels. Same goes for international fillers as well. That's the whole story with our forecast as well. How can we be sure if this is positive, if this is aggressive, conservative, or if this is just the right amount. We always recommend students to go to Bloomberg or Capital IQ or some source that provides you with an analyst consensus, especially if the company is listed. So you want to compare it with the analyst estimates. And usually analyst estimates have forecasts for 2 or 3 years. They don't have 5-year forecasts, but still you can see how your 2-year or 3-year the forecast is compared to the street estimates. One more thing you can do is that some companies do provide guidance, whether it's through annual reports, investor relations, or whether sometimes through news reports or conference calls. In those cases, you can always match to the company's guidance as well. But just be careful, because usually company guidances are relatively stronger in the long term. Short-term guidances tend to be more accurate, while long-term guidances can be very aggressive. So that's just one thing to be careful. And as I mentioned, if you think our estimates are too aggressive or too conservative, you don't have to worry about it. We will build a scenario analysis later on in our course. One last thing before we move on to operating expenses. We want to move to the model tab. And if you see the model tab, finally we have completed revenue. So we want to connect it to the EBIT tab. From the model tab, come to revenue, and we're going to connect it to the EBIT tab. 2024 should be 2024 revenue, and again to the right. And we finally finished one row of item out of all these items in the 3-statement model. But no worries, as I mentioned, revenue is most important, so we spent a lot of time in forecasting revenue, and in addition to that, this was your first forecast, so we tried to go quite slow. Things will speed up as we progress. So that's it for revenue forecast. Let's go and do the operating expenses.